Good morning, traders. It is Wednesday, the 6th of January, 2016. It's 8:02 a.m. Chicago time. Thanks for joining me. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. A fair amount of news overnight driving the markets. You probably noticed that we're down quite a bit. Um, interesting movement in the last couple days here since the beginning of the year. China reports its services sector is near its lowest level in a decade. Services PMI fell 50.2. Readings below 50 signal a contraction in the services sector. This is the lowest it's been since November 2005. The yuan fell 0.6% to a 5-year low in response. Brent crude plummeted once again overnight and has hit an 11-year low. WTI crude is down 3% currently. WTI is it's actually at 3.7% now. WTI crude is trading at 34.65 on the February contract. North Korea says it successfully tested a hydrogen bomb. This introduces further geopolitical risk. Remember, the market does not respond well to risk. Um, Flight to safety. South Korea, the South Korean won dropped 0.8% following the news. That's a 5.5-year low. There was a 4.2 magnitude earthquake detected within 50 kilometers of the known nuclear site in North Korea. This is probably the result of the hydrogen bomb explosion. Fed Vice Chair just came out and says that the levels of uncertainty have risen somewhat. This is Fed Vice Chair Fisher. Levels of uncertainty have risen somewhat. Hard to say how significant recent developments in China will be. And then we got the November trade balance came in at negative 42.4 billion versus negative 44, slightly better. As far as what's on deck for today, looking ahead, we have U.S. Services PMI final at 8:45 Central, 9:45 Eastern, expecting 54.0. At 9 o'clock Central, 10 Eastern, we're looking for ISM non-manufacturing for December, 56.0. Also at the same time, U.S. factory orders for November looking for negative 0.2%. Multiple numbers at the same time, numbers I haven't seen before. Cap goods ship and cap good orders. We also have durable goods orders final for November, no estimate. And then we have 9:30 and 10:30 Eastern, 9:30 Central, 10:30 Eastern. We're looking for U.S. Department of Energy, U.S. gasoline inventories, expecting 2.5 million barrels. On gasoline, crude oil, expecting zero inventories. And U.S. distillates looking for 2.5 as well. Um, Today, also at 1 o'clock Central, 2 Eastern, we're looking for the FOMC release for the minutes from the December 15th and 16th meeting. That's the meeting that gave us the increase, the liftoff on interest rates. This is likely to be a pretty important release, gives us some important insight into what was discussed during that meeting. Let's look at what happened yesterday versus what was expected. For those of you who were here yesterday, the expectation, the primary hypothesis for yesterday was very simple. The expectation is that we would open at the time we were down here. The expectation was we would likely test lower, all the way down to potentially 97.5, the value high. And then we were looking for a bounce up. We were looking for the high of the previous day to be taken out and for it to consolidate and continue towards the to filling the gap zone. 1750 is the primary target for that hypothesis, with 2020 the gap mid being the secondary target. The second hypothesis I went over yesterday was exactly what happened. Yesterday's trading uh, played out the second hypothesis rather than the first. It actually played both slightly, but the second hypothesis played out first. We have initiative buying, and then we fell back towards the value. This gray area is the value high. The value high to test this 98 and a quarter. Value high again is 97.50. So we missed it by 3 ticks. We consolidated, and then the expectation on Hypo 2 is for it to fall into 1992. Remember, I said that the trading, the profile from Monday was very Gaussian, very balanced until the close. This run up happened in the last half hour. So given that it's balanced on a breach of the value high, the expectation is for it to hit the point of control at 92, and then the expectation from there is for chop for the rest of the session. What it ended up doing is what you see here. It did push up per Hypo 2. It did push down per Hypo 2. It attempted to get out of the prior day's range again and failed to do so. And it looked like it was heading, at least I was gunning for 1992. Could not get there, got to 95 and a quarter, and then it found that buyer that just keeps showing up late in the session. It found that buyer, and we had another neutral day. The probability of a neutral day is somewhere around 19.5%. The probability of is 28.5%. The probability of neutral following neutral is somewhere around 19.5%. And that played out. I did not expect it to ride all the way back up and take out the initial balance high. Again, the definition of neutral is a market that takes out the initial balance high and low at some point in the session. The initial balance is simply the first hour trading. And the reason we use an initial balance, the initial balance is essentially a yardstick. It's a rudimentary measure of the participation, the early participation in the session. The theory behind it is very simple. A lot of the business for the day happens right at the open or right at the close. So you'll see this on most days. I can't compare this day here because it was a holiday. But on most days, a lot of the positioning or the higher time frame positions itself in the first hour. In other words, the most urgent business or the most important business of the day is done in the first hour, executed in the first hour. And so we measure the level of participation in that first hour. So that's why we keep track of this opening balance, or the initial balance high and low. There's a closing balance, which we can track, but I don't want to confuse things. That's what these yellow lines on my charts represent. Each line on the chart means something, and none of them are mathematical in nature, really, except for my mid, which is this blue line. The mid just tracks the high and the low of the session divided by 2. Gives me an idea. It's another yardstick that tells me how strong participants are based on where they are versus the middle of the session. It's also used to, especially in situations where the mid and the point of control and VWAP. So in this situation here, we have VWAP, which is the bright yellow, bright blue line, cyan line, VWAP, and then you have the mid floating together with the point of control is a clear indication of a market that's consolidating, and generally that's followed with a breakout. Just a quick crash session there in auction theory and volume profiling. So that's how we ended up. Now, yesterday's action, it was quite bullish. The way it tried to get back into the prior day's value and could not, especially once it pushed out of the initial balance on the upside. It left us with a basically a very classic formation, which we saw the day before here, a cup and handle. Here's your cup, here's your handle, and it just broke through on the upside And essentially, yesterday was the same thing. Gosh, I'm having a hard time drawing here with the mouse. Here's your cup, your handle, and this becomes your pivot point. And generally, this follows through on the upside. In fact, I was looking for that 1750 overnight, and the market did not do that. So overall, the market looked like it was recovering. It was starting to recover from the gap down and was working its way through the gap zone and back up towards where we were auctioning at the end of the year. And all of that was kind of thwarted by the news overnight. China keeps showing us that it is having somewhat of a hard landing, and that's affecting commodities across the board, and crude oil and so on. And it's likely to have contagion effects on the global economy. So you can see here we opened very quiet, very solid open, and normally we would putz around, pull back, and then run up on the Asian session. And what we see here is the China release and the Korean news dropping us very quickly. And then the session just could not recover. And once the European session started, it could not recover. You can see the test of the mid right here, and it's just not able to find buyers. A couple of key things to note. The overnight profile shows there's no consensus on value. The market continued to seek value lower. It's forming lower and lower and lower high volume nodes. We have a weak low. We have the VPOC near the low. The market's still stuck below. This is fairly bearish. In addition to that, we need to step back and take a look at the big picture here. Let me switch this to 120 minute. And essentially what we've done is we have fallen out of balance now, out of the balance that we've been using for quite some time. So let's pull that in. So you look at this profile from October 23rd. We've been in this balance zone for 3 months essentially. The half of October, all of November, all of December. So 2.5 months. And the day before yesterday, we poked through that balance low, which was at 83 and a quarter. We went to 80 quarter, and we recovered somewhat. But now we're trading at 75. 75. In fact, at 74. This 75 was the next target down, and we got below it to 71 and a quarter. We're trading at 76 now. We are pushing past the composite low volume node here, and it's quite bearish. So it's looking like the market, although it did look like for the last day or two, I did warn shorts to back off a little bit or hedge their position. It looked like we would have another one of these recoveries here, like we've seen with every test of this low, where we just push lower and we rip up, just tearing up those bears. But with this, it looks like there's a lot of overhead resistance to work through now, and it has fallen out of balance, and it has fallen out of the major high volume node that we've put in for a few months now, and it's looking like we are likely to start pushing lower and testing lower prices from here. That's the bigger picture consensus as it stands right now. That's how things are shaping up. I'm going over my time here a little bit, but I wanted to show you this. This is the weekly. I don't see my monthly. I guess my monthly's not here. But I wanted to show you, so this is a weekly profile chart. This every one of these profiles shows what has happened in that week. And you could see that going back to October, right back here, so this is where our balance zone was, this massive area. and we are just pushing past it. We're pushing back a little bit. We're back into the October 12th week that we're trading in now, and that drops us down to the lower 70s, and we're starting to push back, push down through that as well. So here we go below us, um, in the 1960s. We do have a high volume distribution here, and that becomes the next big area down here at 1964 is the next big area to test, the next big acceptance area to test. You can see it here in the composite. So that's how things are shaping up. I'm going to be pressing the short side a little bit more than the long side, but we do have, for today, we do have a gap down, and as a response to the gap down, the way to look at this, the way the auction operates is to look for responsive buying. So the primary hypothesis for today, the expectation is for this to make an attempt higher, but I expect it to take the overnight low at some point. But I do expect an attempt higher. It's probably going to open out of range, open auction out of range, try to push higher, and then likely to see some sellers step in and push it through this 71 quarter low. And then the target, if it continues lower, the target, as I said, would be in the 64 area down here. That's the primary target that we're looking for right now. So that's the primary hypothesis. The secondary hypothesis, open auction out of range, pushes down into the overnight low, consolidates and starts to find buyers and starts to work its way back to the 1990 area, and then the target would be 1992. That's the secondary hypothesis. I'm just going to wait and see which side is dominant first, and if it's met with any support or resistance, opposing behavior. The market lately has had strong participation from both sides, so these prices might be considered cheap by many, and then there are others who are seeing these geopolitical and economic issues and maybe pushing their hedge or liquidating their positions. So we have two-way action. We see these big swings now, and I think that's likely to continue. Januaries are generally tough. The beginning of the year is generally tough, and by the end of January, supposedly it sets the tone for the rest of the year. But we generally get this battle once we're done window dressing at the end of 2015. We get this battle at the beginning of the year, and it involves the titans of the market, the giants of the market, and so you end up with this two-way, wider ranging participation, and it creates opportunity, but in that it also creates more risk. Anyway, I can't be more specific than that currently. That's just it's just the way the market is. Just watch your risk. Just stay in the game. It's just don't blow yourself out at the very beginning of the year. Don't fight. Don't fight. The market's not here for you to fight it. The market's here for you to align yourself with it. And that's the difference. We're using probabilities and we're using a trade plan or an approach. And the whole goal of that is to align ourselves with the market. So if you find yourself, selling into a rally, or buying into a drop, you're not riding the wave. You're essentially trying to surf against it. It's a losing battle. It's frankly, sorry to say, it's just stupid. It's just a stupid way to lose your money. If you're going to lose your money, lose it by committing to a lot of trades or by taking a lot of trades. That's the goal, is to make each trade count, make every loss count. And if your losses are such that you're just going against the market and adding against the market and adding against the market and babysitting a losing trade, you're not a trader, you're a gambler. I know that sounds harsh, but it is the truth. And I see that happening all the time with some of the traders at stage 5 as I'm monitoring risk. Those are the people that end up getting a phone call. It just doesn't make sense to do that. Wait for the market to tell you what it wants. Wait for the dominant force to come in. You have time. You've got at least 6 hours to do something with the market. 6.5 hours. So just chill out. and let it tell you what it wants, and then go with the pullback in the direction of the dominant force. And the market presents those opportunities um, throughout the day, in my opinion. So that's my advice to you. Good luck today, and I'll catch you tomorrow. Take care.